And welcome back to the next video. Really important section this, and that is your future investment structure. There's lots of ways that we can invest, and getting the right investment structure is vital. And generally it may be one structure for larger amounts of money, it may be multiple structures, depending on what type of money or the amounts of money we can get into superannuation. So we'll just sleep in, and of course with all these, we're putting our general advice disclaimer to say this is not personal financial advice. So we've got it all here in one slide, so lots of information. Of course, when it comes to the investment structure, what structures you use will determine the amount of tax that you pay on an ongoing basis and also on an initial basis. But obviously superannuation is at the top of the list, and it's ideal for people that are in retirement, and we can, as individuals, have up to $1.6 million invested into a superannuation pension. And once you're over 60 and retired, that's going to be, the income you receive from that will be completely tax-free. The tax within the superannuation pension once you're retired and over 60 is tax-free as well. So normally in accumulation you would be paying 15% within the fund on any income that the fund receives. But once you hit 60 and retired and kick off a superannuation pension or an account-based pension, there is no tax within the fund, no 15% there, and there is no tax that's paid when the pensions are paid out to the member at all, up to the $1.6 million. So for a couple, that is $3.2 million. In my view, that's extremely generous, and that's probably the gold standard that we've got to try to get to first. And obviously getting money into superannuation has become more difficult in recent times, but there is the small business capital gains exemptions that can help get a lot of money into superannuation, particularly on retirement and when we're selling active assets like farming land. Discretionary family trust, that's where it gives us a huge amount of capacity to invest within a trust, and then we can distribute income and also the capital gains to many beneficiaries, so not just mum and dad, but children, grandchildren, and so on. So it gives lots of flexibility, and when we're distributing income, we need to be mindful of the beneficiaries' circumstances. Does that upset their tax implications? Does it upset their Centrelink payments and things like that? So you need to be very mindful. And then you can have probably the more common and very simplistic way to do it, where you can just be an individual or joint ownership. So depends on the amount of money that's invested. We still set up plenty of accounts that are jointly held with husband and wife. It makes it very easy from a estate planning point of view, but also for individual investors if we've got a small amount of money to invest, rather than going for a complexity of another entity like a family trust. There's nothing wrong with setting up individual ownership as well, except it doesn't give you any flexibility. If I've got income from investment in my name, I can't send that off to a beneficiary elsewhere. So obviously the amount of money has a huge bearing on what we'd recommend for clients and how it should be structured moving forward. But again, seek professional advice in this area. But I think definitely superannuation is first, because we know that you can have up to $1.6 million each completely tax-free. Thanks for listening. In the next one, we'll be covering off obviously a small video on Centrelink planning. Thanks for listening.